At the beginning of the year, there were so many bank hubbubaloos, and everyone was pointing and accusing fingers at crypto. Some used the problems to elaborate on the imbalances of the crypto industry and why it shouldn't have been accepted into the monetary system in the first place. The point is that not every bank failure is caused by crypto, and the recent ones are no exception. And instead of tearing each other apart with accusations, a solution is needed. Perhaps that's why we have to listen to the Cardano founder a little more. Financial conditions continue to be fluid, and crypto has always been a great opportunity to learn from the mistakes of others to build stronger and more resilient applications. So let's flip back to the past a bit. Out of the many reasons behind the catastrophic collapse of the Silvergate Bank, followed by Silicon Valley Bank and Signature Bank, marking the second and third largest banking collapse in US history, the cryptocurrency industry isn't one of them. Let's get that straight. The true culprits behind the banking crisis were a mix of corporate mismanagement and inconsistent regulatory responses. Now that we've clarified that, do you share the same opinion? The reality is a bit more nuanced. While the investigations are still being made public, it does not look like crypto is the primary culprit for this financial instability. Crypto may have been associated with the financial institutions, but several other factors contributed to the instability and uncertainty in the financial sector. As fears of bank failures spread around the world, the contagion threatened to engulf crypto. Signature Bank, crypto's last major ally in the banking world, was seized by regulators in the aftermath of the Silicon Valley Bank failure. Remember that Signature played a key role in the US crypto ecosystem. Furthermore, New York-based Signature Bank was not exclusively a crypto bank. It had a hand in its real estate lending and law firm services. However, during the crypto pandemic era bull run, the bank became one of the major legacy institutions to embrace crypto, holding $10 billion in crypto deposits by January 2021. At the time, Eric Howell, one of the bank's executives, bragged that the bank was the preeminent player in that space. Signature Bank ran the payment system Signet, which allowed crypto companies to instantly transfer money in and out of crypto at all times. Notably, since 2019, Signet and its main competitor Silvergate Bank Sin have been responsible for moving more than $2 trillion in and out of crypto, according to Forbes. But after the preposterous fall of FTX, Signature sought to distance itself from crypto, especially since the exchange platform had been one of its clients. In December, the bank said it would offload $8 billion worth of cryptocurrency to reduce its exposure to the stormy industry. And as a result, Signature's decision was worrying, but not backbreaking for crypto, as the industry could rely on Silvergate Bank and other crypto-friendly institutions. But then Silvergate was hit hard during the crypto's decline in value last year and announced on March 9th that it would be winding down operations. And even if we didn't put our eggs in those two particular baskets, we still have a sad tale to tell. Following Silvergate's demise, JP Morgan predicted that some of its customers would migrate over to Signature Bank. Meanwhile, according to venture capital investors and crypto executives, exploration done on Silicon Valley Bank was another alternative option. It was at this period that other experts stepped up. Nellie Liang, U.S. Treasury Department Under Secretary for Domestic Finance, didn't believe that digital asset sector should be blamed for the runs on Silicon Valley Bank and Signature Bank that led to their quick demise. I don't believe crypto played a direct role in either of the failures, Liang said during a hearing at the House of Financial Services Committee. When asked whether digital assets were an indirect factor, she noted that Signature was particularly active in the sector, giving no further details. Okay, so enough of going on and on about circles, let's hit the nail on the head. The outspoken Cardano founder Charles Hoskinson just said something that sounds like a solution to these bank failures. Probably we shouldn't expect much from him. Does an opinion from a mathematician and founder of cryptocurrency that has no balls in the crypto market count? Well, whether it counts or not, Hoskinson compared the operations of major cryptocurrency firms like Circle, Paxos, and Tether with those of banks, emphasizing that these firms have endured conditions that largely cause banks to fail. Circle, Paxos, Tether. We're going to hold collaterally mostly in cash and T-bills. Nothing happens. Government. Crypto is super risky. Banks. We're going to hold collateral mostly in longer drafted TradeFi bonds. Banks fail. Government. See, crypto is super risky, he tweeted. According to him, despite the resilience of these crypto companies, the perception regarding crypto has not changed a bit. And we can't agree more, given the disastrous accusations leveled against it. In January, the White House released a statement titled, "The Administration's Roadmap to Mitigate Cryptocurrency's Risk," where a massive chunk of the legislative advice provided by the admission was directed at the US Congress. If there's anything Charles Hoskinson wants everyone to know, it is not blaming crypto for all this trouble. He has been proactive in trying to get out the word that he doesn't believe that this should land on the doorstep of crypto. In a public statement, he encouraged people not to listen to any negativity trying to connect bank collapses with cryptocurrency. This simply implies that he knows of a solution to this drama that stems from crypto. The central banks and politicians created this banking crisis, and now they're blaming crypto. Don't fall for it, and keep a list or reminder at the ballot box when election time comes. Be a single-issue crypto voter, he said. Perhaps Hoskinson specifically felt the need to release such a strong rebuke in response to the comments made by John Van Overveld, a member of the European Parliament, who called for a strict ban on cryptocurrencies. Van Overveld called digital assets speculative poison, thus advocating for a key step into fighting the negative forces that are plaguing the banking world. Also in a live stream broadcast, Hoskinson lashed out against the banking system and how it is presented to the world as infallible. Things that seem permanent and stable, they change quickly, and it's something that people don't want to admit. But then after the fact, they say it was obvious, he said. The Cardano founder has developed a reputation for a staunch defense of crypto over the years and doesn't want to take accusations lying down. As crypto is striving for widespread global adoption, negative connotations could present major obstacles, especially if there is speculation and not a matter of fact, given his comments that this is something that the Cardano founder is willing to go to the mat to defend. In a way, although some of it call it a green light, crypto adoption in the US increased amid fears of full-blown banking crisis, according to a poll. 22% of Americans, over 1 in 5, said that they own at least one form of crypto in April, representing a 4% increase from January. Not surprisingly, Bitcoin was the most widely held digital asset in April, with 16% of respondents say that they own some of it, and that's up from 13% a year earlier. Ethereum was the number 2 asset with a 12% ownership in April 2023, followed by Binance Coin and Tether at 8% each. Again, the increase in crypto ownership was likely tied to ongoing market jitters involving the banking industry, especially the failures of Silicon Valley Bank, Signature Bank, and more recently, First Republic Bank. That's good news, but is it sustainable? Charles Hoskinson has always been a lover of decentralized finance, and now he advocates it as a resilient solution to the banking crisis. He once said, "The winners of the future in the DeFi space are going to have liquidity and interoperability, the ability to move multi-chain, and finally, cost predictability is such an important thing. It's so bizarre how we just tolerate massive swings in the price of doing business." Indeed, Cardano did not make it to the first wave of DeFi, which generated superstars such as Uniswap, MakerDAO, and many more. However, despite calling DeFi's current state a bubble, Hoskinson remains bullish on DeFi in the longer term. According to the founder, Cardano has had his eyes on the so-called second wave of DeFi all along. We need governance, we need certification, we need insurance, and we need regulation on these things. Metadata identity. At the same time, you need to decentralize. The next wave of DeFi will do that with a straight face and will be significantly harder to regulate in a traditional sense. The way we constructed Cardano was for that second wave, Hoskinson said. Plus, Charles Hoskinson made a satirical remark when he applauded the demise of 5 major banks and predicted that digital assets and decentralized finance would soon replace the current financial system. Hoskinson wrote in his tweet, "If only we had a different way to running a banking system. If only we had a different kind of money." It will be interesting to see how Hoskinson's idea morphs into a solid solution for banks and crypto in general. The future remains to be seen, but there's one thing for sure, and that is we want DeFi all the way. But that's going to do it for today's video. Once again, thank you for watching, and of course, don't forget to click on the subscribe and notification buttons so that you don't miss out on our other videos. With that being said, we'll see you in the next video.